Double entry bookkeeping, also referred to as duality, is one of the most important concepts in accounting. This concept forms the basis of preparation of financial statements. A brief online search indicates that most learners are prioritizing the following questions. Number 1. How do you record the double entry transaction? Number 2. What is the golden rule of double entry bookkeeping? Number 3. What is debit and credit in accounts? And the last one, is double entry bookkeeping hard? This video will help you answer the first 3 questions and more, and hopefully you will be able to answer the last question by yourself. Hello and welcome to the Accounting Feed. I am Philan and I'm your host for this session. Let's dive into it, starting with the origins of double entry. The roots of debits and credits, which is double entry, can be tracked back to 15th century after the Italian Luca Pacioli, a man considered to be the father of modern accountancy, invented it. He described the system used by Venetian merchants in his work. But what exactly is double entry bookkeeping? Double entry system explains that each transaction affects 2 separate accounts, where one is debited and another one is credited. This is necessary to standardize the accounting processes as well as minimize errors and improve accuracy of financial records. The question that comes to your mind then is, what are debits and what are credits? In practice, credits represent the source of an entity's economic resources. Thus, credit entries record increase in income, liabilities, and equity, as well as decrease in assets and expenses. Conversely, debits represent the destination to which the said resources are consumed. Therefore, these include increase in assets and expenses and decrease in income, liabilities, and equity. In accounting, income, expenses, liabilities, equity, and assets are referred to as elements of financial statements. For more on this topic, please follow this link. So, why double entry? Double entry system has the following benefits. Firstly, it enhances the accuracy of financial records. This is because when implemented adequately, it helps to prevent errors. Secondly, it leaves an audit trail. One can track all transactions from their start to their conclusion, and in case of errors, it is easy to trace. Finally, it will also help in preparation of financial statements, which can be relied upon by internal and external users. Demystifying debits and credits. To make this clear and easy to understand, it is crucial that we eliminate some of the most common misconceptions about them. As much as debits and credits are opposites, positionally, as well as in terms of recording, they do not necessarily imply the following. Number 1. Addition and subtraction respectively and vice versa. Number 2, increase and decrease respectively and vice versa. Therefore, we can say that debits and credits are simply a theoretical basis that ensure that transactions are recorded in an orderly manner. Transactions are recorded in a ledger account whose visual appearance is T-shaped, hence why it is also referred to as a T account. The left-hand side of the account is called debit, and the right side of the account is called credit. So it looks exactly like this. On the left side, debit, DR, and on the right side, credit, CR. Every debit entry will always have a corresponding credit entry of an equal amount. Debits represent increase in assets and expenses, as well as decrease in liabilities, equity, and income. Credits, on the other hand, represent increase in equity, liabilities, and income, as well as decrease in assets and expenses. In summary, it looks like this. Double entry bookkeeping is applied in a systematic process that culminates into the preparation of financial statements. With this in mind, it is important to build an accounting equation. The accounting equation explains that the sum of assets is equal to the sum of equity and liability. Let's now look at the application of double entry in real business transactions. In order to apply this, you'll need to do the following. Number 1, identify the 2 accounts affected by the transaction. Number 2, consider which elements of financial statements they are. Number 3, apply this table to identify which account is to be debited and which account is to be credited. The first of the transactions is sale of goods either in cash or on credit. In this transaction, the two accounts affected are sales revenue and cash or receivables. Sales is an income, and since it is increasing, we will credit it. Cash or receivables is an asset account, therefore this is going to be debited. This transaction can therefore be summed up as follows: debit receivables or cash, credit sales revenue. The second transaction is purchase of goods in cash or on credit. Here, the accounts affected are purchases and cash or payable, depending on whether, again, we are purchasing goods in cash or we are purchasing on credit. Purchases can be categorized under expenses. Therefore, its increase means that we need to debit it. Cash is an asset, so if we pay for these purchases immediately, then our assets decrease and therefore we'll credit cash. If we purchase the goods on credit, however, we create a liability called payables, and because it is an increase, we will credit this account. Therefore, in terms of a journal entry, it will look like this: debit purchases, credit payables, or cash. The third transaction I want to use is borrowing a bank loan. In this case, a liability, that is bank loan, will increase, and the cash at bank will also increase. This transaction can be represented as follows: debit cash at bank, which is an asset, credit bank loan liability. Another transaction I want to use is issue of new equity shares for cash. New issue of shares increases a company's equity capital as well as its cash at bank. Cash at bank is an asset. Equity capital is, of course, an element of equity. As such, the journal entry will be as follows: debit cash at bank because of the increase in assets, and credit equity capital. What happens if we receive cash from our credit customers? In the earlier credit transaction, we debited receivables and credited sales revenue. In this one, however, receivables and cash are two accounts affected. When an entity receives a payment, we will debit cash at bank since this is increasing our assets, and our receivables, which also is an asset, is decreasing. So we will credit that. Therefore, debit cash at bank and credit receivables. The final transaction is payment of cash to credit suppliers. When we purchased the goods initially on credit, there was an increase in payables, hence we credited it. However, when we pay our credit suppliers, our payables will reduce, hence we will debit this account. Our cash, on the other hand, will reduce. Because this is an asset, we'll need to credit it. So in terms of journal entry, debit payables, credit cash at bank. So this marks the end of our session today. If you like what we do, make sure you subscribe to our channel, The Accounting Feed, like, comment, and share. In case you have any questions, please do not hesitate to post them down below in the comments, and I'll take my time and answer all of them. Have a nice one, and see you in the next session. Cheers!